them yet, then definitely keep an eye out for that link here that I'll post a little bit later, because even if you don't go ahead and proceed with the course that I put together, you'll definitely still learn something from those videos, I'm sure. The course I ended up developing and that you'll see, mentioned here at the end of the webinar is an 8-week course, and it's a very integrated course. It takes you from the beginning of understanding the different Fibonacci techniques to learning the ability to read pure price action. So understanding trend development and momentum and how those things come together and the interplay between them. And that's what you're going to see in today's webinar very clearly. You'll see that I'm not just focusing upon Fibonacci. I'm using a core understanding of reading pure price action in order to determine which Fibonacci levels and which Fibonacci tools I want to use. So without any further ado there, let's go forward and basically dig into today's information. And like I said, I will keep in mind the fact that you guys haven't had that introductory material yet, or so many of you haven't yet. To begin with, today's class is going to be focused primarily upon using Fibonacci projection points to time targets. Now, this is one of my favorite techniques for using Fibonacci. I will use them for timing entries to a great degree as well, but the precise target levels can be basically found so much more clearly when you're applying Fibonacci projection points to time those target levels. Now, I do, a lot of my trading I've done over the years has focused on pure price action. And I've looked at many different indicators over the years. I came into trading about almost 16 years ago now, and at the time didn't use any indicators at all other than just simple moving averages and volume, and that was really it. And like a lot of people out there, I went and tried to find something that would work really well for me that I could apply to enhance my trading. And what I found very quickly was that there were very few indicators that were really reliable over time. There are plenty of indicators that work well if you already have a really good understanding of things like trend development and like momentum. However, if you rely on the indicators alone for your timing, then you're going to get a lot of false starts, a lot of trades that you'll enter that'll end up turning around on you right away, or you'll basically use your stop levels a lot differently and inappropriately than compared to using pure price action. But when it came to Fibonacci, I really couldn't find a downside to it. I couldn't find anything against it. It worked no matter what type of trend I was using and what type of time frame I was trading and whatever market I was focusing upon. Personally, I trade most often Forex, E-mini futures, and individual stock securities. So that is my core focus for trading, but I do all different time frames. I will scalp the ES, for example, or I will have swing trades on the different currency pairs, or even long-term investing on individual securities. So I really kind of have my toes dipped into a lot of different markets, and the markets that I trade on any given day, really I trade around my life. So however time I have on a given day, I look to see what markets are active, and that's where I trade. However, there's many times that I will sit and spend, longer periods of time focusing upon one market. So I don't want you to think that you have to jump around to use the techniques and tools that I show you in this webinar. I spent 12 years, for example, running an online trading room pretty much from open to close, and then doing a lot of pre-market action trading Forex. So, it's definitely something that you can use with consistency no matter which market you're trading. It's just that you can also have that ability to go from one market to the next if that's what suits your personality and your lifestyle. So In today's class, we're going to look particularly at the Fibonacci tool, but using it for timing the targets, and I'm going to share with you how to use two types of Fibonacci projection points for these target levels. There's a 2-point extension and a 3-point expansion. The 3-point expansion is still a variation of an extension point, so depending upon which charting platform you're using, you might still see the 3-point expansion, Fibonacci expansion, labeled as a Fibonacci extension. So you'll want to talk with your charting platform, your broker, to determine how exactly they have those set up and labeled. And as we go into some of these different types, there's also going to be a few tricks that you can do to add some of the levels onto your charts that you might not see if you use the toolbar for the Fibonacci tools. The core levels that I use in Fibonacci when I apply it to my trading are basically based upon the 23.6, 38.2, 61.8, and 76.4% Fibonacci ratios. Now, the first video that I did last week focused upon the background history of where these numbers come from and beginner applications for how to apply them, particularly using them to time entry techniques. One of the strategies that I showed focused upon a continuation strategy, whereas another showed how to use them and the development for a reversal strategy, a trade that I call a trade pattern that I call momentum reversal. And I'm going to share with you guys both of these techniques in today's webinar as well, because if you have to pick two strategies to begin with. If you're just getting into trading or you're an intermediate trader and you're looking for that area to kind of enhance your edge, these are the two strategies that I really highly recommend to anybody, because variations of these strategies are very easy to pick out, and you can develop very clear-cut checklists of pros and cons for the strategies themselves. Now, other favored levels that you can use with Fibonacci are things like 27.2, 78.6, and these are based upon the square roots of the other ratios, the other numbers here. So when you get into kind of more of the details of Fibonacci analysis, these are some of the other levels that you're going to come across. The strategy that I'm going to begin with today as the core focus for timing these target levels is one that I call a two-wave continuation. Now, within this particular pattern, what I'm looking for is, let me grab my drawing tool here, basically a counter trend move that follows an impulse move. So the small a here represents an impulse move. Let me go ahead and close out some other stuff here, since my drawing tool is a little bit on the slow side this morning. I had all my charts running, of course, from trading earlier today. Let's see if that picks things up a little bit. Okay, so following that impulse move, what I'm looking for at that point are now two pullbacks or corrections where we're looking at a counter trend move. Now, for those of you that have had a chance to watch the first video, you'll notice that one of the core Fibonacci levels that I want to see on this correction is the 23.6 to 38.2% Fibonacci retracement level as support for this correction, meaning that as this first pullback hits or the second pullback hits, I want those lows to correspond to the 23.6 or the 38.2% Fibonacci retracement level. Now, a Fibonacci retracement is a movement whereby you are going from the left of a trend move to the right of a trend move using your Fibonacci retracement tool, and that will create these levels of correction as the prices pull back on themselves. The key focus for a correction that is to that 38.2% Fibonacci retracement level and not further than that, is that typically a retracement of this degree or less is going to yield a stronger breakout when the continuation takes place versus if you had a correction of, say, 50% or 61.8%. I am going to show you an exception that is a very strong reversal strategy that recently took place in the overall market. So you will find exceptions to these rules. And this is where we're getting into not just looking at the Fibonacci levels, but also developing an understanding of trend development and momentum. Because it is not just the Fibonacci levels alone that are going to determine the strength of these pivot points at the highs and the lows. If we were just using this two-wave continuation strategy in and of itself and not taking into account where it's taking place in a larger trend or what the momentum is like, then that 38.2% is the absolute greatest retracement you would want to see in order to see a strong continuation strategy. So if you're in doubt, stick to a strategy that hits that 23.6% or 38.2% retracement. And sometimes it'll be the 38.2% on the first low and the 23.6% on the second low. You can also use that 27.2, but personally, I don't use that one as much. So in the course itself, though, I do show you a number of applications for the 27.2 along with the 23.6. And the basic idea behind these Fibonacci levels is that you're dealing with support or resistance levels. And it's not necessarily that the 23.6 or the 27.2 is really better than, one is better than the other. The level, basically the zone between the two of them can be considered a support or resistance zone in and of itself. And typically the difference between the two is pretty slim. And if you're dealing with a security where the trend is large enough that it is wider, then you can usually apply the Fibonacci levels to a smaller time frame to help you pinpoint even closer support or resistance levels using Fibonacci clusters, which is something that I will share with you guys here in just a couple of minutes. Now, in this strategy, let's go into some of the details here. I use an entry trigger based upon a break in the second correction. So as the second pullback breaks higher, that's my entry trigger. My stop is under the second low. And that does not matter whether or not this is a higher low or a lower low. I'm not using the overall correction here to time my entry triggers. I'm using the second wave itself. Now, a traditional target on this two-wave continuation pattern that is going to hit most often is going to be 100% expansion of the initial impulse move. So this rally that took place here will typically yield 100% measured or equal move on the breakout when the two-wave pattern continues. Now, if we go and look at an individual trade that took place here. This is a strategy that I traded in the S&P 500. And what you're looking at right now is a daily chart of the ES. And this is the instrument that I will typically use when I'm trading the indices. I like to trade them using futures contracts. But you could have also done it using the spider. And in fact, you'll see on here, I drew a Fibonacci expansion. And an expansion is a three-point projection, which I'll show in more detail here in a minute, where I looked at the initial trend move here, the correction, and then the expansion. So this is, in and of itself, a two-wave correction here. It's just a bit of a variation compared to what I'm teaching in today's webinar. But it still typically has that 100% expansion level as a target zone. And if you were trading the spider, this level, or the 100% level, hit even better. It hit like almost exactly at that 100% expansion. Now, as this was coming into this resistance zone, you'll notice that the momentum is shifting. It started to shift at the 76.4% Fibonacci retracement, or Fibonacci retracement here. Sorry, Fibonacci expansion. Getting ahead of myself. It started to stall rather at the 76.4% Fibonacci expansion level, which was the retracement back into the zone where this previous breakdown took place. So a channel break like this is typically a strong resistance level in and of itself. And when prices retest that level, it becomes a zone where it's quite common to see momentum shift. And a lot of times you might see an absolute high hit or hold at that level as well. So this corresponded to the 76.4% Fibonacci expansion here and helped slow the momentum going into the 100% expansion. Now, at this point, this is where I did one of my market commentary columns for the street, where I basically do a larger market overview, what I'm expecting whenever we're coming into major support or resistance levels. And I spoke with the subscribers and said, we need to be looking for reversal strategies at this point. We need to be looking for something such as, for example, a two-wave continuation on the downside. And in this example, because we have momentum shifting, we're going to see an exception to some of the rules that I shared with you on the template itself. The security here, the index, pulled into the 21 period moving average, based along and congested along that support, and this is where we saw that two-wave continuation strategy begin to develop. Here was the rounded lows coming off of that 100% expansion level, or the rounded highs rather, coming off that 100% expansion level, and then the first initial impulse move on the downside. At that point, we saw a corrective move take place. And you'll notice very quickly that this is more than that 38.2% Fibonacci retracement. It pulled into a second low and then pulled off of that second low with very even regulated moves back and forth, pretty much V's and inverted V's. And that is pretty decent for two-wave continuation. Oftentimes what you would like to see, though, is a little bit of a shift in momentum right here, where it will slow down a little bit further. And what that does is it allows these previous lows to break more quickly without a pause. So this has momentum that is fairly similar from B to C and D to E compared to each other. So what happened is that as this tested the low from D, there was a little bit of a pause at that level, or a support at that level. And it basically fell into a smaller trading range before it ended up breaking lower. Now, the entry timing on this was a little bit tricky because we had some flush action here that was taking place midday here, where you can see it kind of plummeted and retested the high. Now, this is where tools such as the Fibonacci fan and intersecting the fan with a Fibonacci arc and combining that with time extension can help you with timing the exact entry a little bit more clearly. But we don't have time to get into that today. I go into that in really great detail over the next 8 weeks. But to begin with, there's still techniques that you can use to kind of show you, is this timing okay, or am I still a little bit too early? One of the key ones is compare the first correction to the second correction. And you want that second correction to last at least as long as the first correction. By the time it tried to break here, it wasn't really quite long enough because it took all the way to here to start to get momentum building on the downside for this next drop here. So that really meant that over in here would have been more of an ideal location for the continuation. My own trade took place as it formed a smaller time frame continuation pattern right here. You can see the congestion a little bit. But if you were just using this 90-minute time frame chart, you could have taken the first low and the second low and extended that to give you an entry trigger. This had a risk level above the second high here, basically giving you this as your risk parameter that you would be using when you were determining, okay, is this trade going to be worth taking based upon the potential that I could have on it? Now, in a two-way continuations trade, you're going to typically look for at least that 100% expansion level. And that placed it right around in here, just based upon the core strategy alone. So that would have meant that if you were using this channel break here and a stop over this high, that first target level with the 100% expansion would have only really given you about 1-to-1 compared to what you were risking. And here is where the trend development really comes into play. Because when you are dealing with a trend that is coming to an end and the momentum is slowing, whereby you see rounded lows, you have not only a better chance of getting a retracement that is more than that 38.2% and still one that will trigger a two-wave continuation move, such as here, but that two-wave continuation will typically yield more than the 100% expansion. And again, this is tied specifically to the fact that it has slowing momentum into the high, and it was the first continuation pattern on the downside, kicking off what could have potentially been a new downtrend. You wouldn't have known that when you were first getting into the trade. You know, you'd be hoping that that would be the case, but you wouldn't know it until it actually confirmed. So it's basically the first continuation pattern of this reversal off of the rounded high. And these particular characteristics determine whether or not it has that potential to hit the 100% expansion or hit an even greater percent expansion. And it also meant that it was perfectly fine that this retraced to that 61.8% Fibonacci retracement level as opposed to holding that 38.2%. In fact, when that particular trend development and particular momentum development happen, this type of two-wave continuation strategy is even more ideal if it does pull up to the 50% or 61.8% retracement level. So those are the zones that you will watch for this very specific one. And I'm going to show you another exception here in a little bit where you actually cannot look for that 100% expansion. But let's look at the techniques that we can use for identifying target levels. The two that you can rely on to start with are Fibonacci retracements and basically Fibonacci retracements used as extensions or pure Fibonacci extensions. And these are basically two of the same thing. You know, in one case, you are adding the extensions to your retracement tool, and this is where most of you will find that it is not a default setting in your Fibonacci retracement tool. You will have to add those levels, and you can do them by going in and adding like the negative 23.6, negative 38.2, etc. And that's going to create extensions of this impulse move, but it's going to add them to the retracement tool. So it will show you the retracement levels. In this case, I just left the 50% on here, and it will also show you those extension levels. You can do a pure price extension as well, and I'll show you that here in a minute. Another way some people will use the retracement tool is they will go backwards in time, and they will go from the most recent action to the prior action and give that as the extension level. So basically they're going from 0 to 100, 200, and so on and so forth. It doesn't really matter which way you do this here because it's going to give you that exact same extension level. But it's going to be a little bit confusing when you're looking at retracements because it doesn't really make sense. This is not, for example, here a 38.2% retracement. It's a 61.8% retracement. So even though I've seen people do this a lot, I don't really suggest doing it, but I wanted to share with you guys here anyway because I know so many of the videos out there are showing you that that is the way to do it. And really, when you're looking at extension tools and projection tools like this, you are going from left to right when you are drawing your retracement level or your extension level. So if a trend is a downtrend, you're going from a high to a low. Now, a pure price extension does not show these retracement levels here. And this is what you will use if you're looking at just the target levels alone, and you're not really looking at a retracement back into a congestion. And that will project some pretty decent levels of support. Now, just using the extension levels here, going into this trade, we knew we'd be looking at more than a measured move. So this gives us some additional levels of support to watch for as the trade unfolded. If we go a little bit farther and we add a Fibonacci expansion to this, we are looking at a 3-point projection, whereby we are looking at that initial impulse move here and then the two-wave correction itself. And when drawing a 3-point expansion using a two-wave continuation strategy, that third point, C here, is going to be the high of the second correction or the second wave. So here, A to B would be where you would start your expansion tool. You would click here, you would click here, and then you would click here, which would be that second high. And that's going to give you the most accurate projection points using this particular strategy. Now, different variations of different strategies, they will use different pinpoint levels that will give you the best results. And it took me a lot of years to really determine, okay, well, which points in this particular strategy are the most important for drawing the Fibonacci tools. And this is one of them that you will find is a lot stronger than if you're using some of the other points within the congestion or the correction itself. So this gives us levels where here's that 100% expansion, which would be the typical target on a two-way continuation. But going into this trade, because of the trend development and the momentum, I knew that my odds of getting more than the 100% were very strong. So what are the next levels of support that I needed to be watching? Well, here's where I went and I not only added the Fibonacci expansion, which you're seeing here, and the details up at the top of this are showing how to draw that in MetaTrader, but I also added the Fibonacci extension levels to this. So this is going to create clusters for support, where the extension and the expansion tool is going to have different levels where you will see them almost intersect and come together. And those become those additional target points that you can watch for. Now, already knowing that we would get more than 100% expansion meant that I needed to look at what would be the next possible support levels with these clusters. And I don't like to add too many to my chart because it becomes, well, too clustered. But just the extension and the expansion are going to be really, really helpful when you're looking at these target levels. And it's going to help you hold on to these trades a lot longer. The next thing I want us to look at here is that when we look at the trend development itself, as this trade unfolded, what you will see is that there were 3 waves of downside, typical Elliott wave trend move here, 1, 2, 3. And so usually when you have 3 waves of downside into a 2-wave continuation pattern, that trend will be mimicked coming out of that pattern. So with 3 waves into it, there's a good chance that you're going to see 3 waves coming out of it. If there had only been 2 waves going into it, you've probably only seen 2 waves of continuation coming out of it. But as we look at the trend development itself, you'll notice that it shifts. The momentum changes. Initially, it starts out gradually. Then there is an increase in the momentum. And this brought it into the first Fibonacci cluster level that would have served as the initial support level because we had similar momentum moves on each of those two waves of correction. But with the increase in momentum here into that support level, it basically gave you that added confidence, or it would give you that added confidence that that level had a really strong chance of breaking. So as it was pulling into this zone, I wasn't really worried about protecting any of my profits at that point because the larger time placement and now the momentum itself told me that I was really well positioned for this continuations trade here. But when you have an increase in momentum like this, it also tells you that you're probably going to get a larger than measured move on this continuation. So if you drew an expansion of the second wave down, for example, compared to the third wave down, that 100% level would hit right about here, which is that next cluster level after the 100% level. So, or the 100% expansion level. So here's that next cluster level. And because